Today, Bitcoin has entered one of the rarest structural environments we track, a full conflict regime, where multiple high-signal indicators fire at the same time but in different directions. This doesn't happen often, and when it does, it tells us the market is at a statistically important decision point. In this update, we're going deep, not just into what the indicators are saying, but how they work, why they exist, their mathematical logic, and how to use them to understand where we are in the cycle. Let's begin with meaningful volume. Most traders use traditional volume. The problem is that raw volume doesn't tell you anything about dominance. It tells you how much was traded, but not who won the battle. Meaningful volume solves that by measuring absorptive volume, the part of trading activity that actually pushes price through liquidity layers. In simple terms, it analyzes whether buyers absorbed sell pressure or sellers absorbed buy pressure. When MV prints a large positive spike, it means buyers dominated the tape and absorbed every sell order thrown at them. When MV prints a large negative spike, it means sellers overwhelmed the buy side and forced price lower. Here's how it works under the hood. Meaningful volume uses directional expansion to determine whether a volume node is favoring the bid or the ask, and then tracks how much volume occurred while price moved through meaningful ranges, discounting chop and micro reversions. This transforms volume from a simple activity counter into a pressure detector. This week, MV printed a significant negative reading on the weekly timeframe. Historically, deep negative MV events appear in two scenarios: early in new downtrends or late in capitulation phases. The difference depends on structural trend. Right now, with weakening structure across multiple models, the statistically consistent interpretation is early downtrend. But MV is a context amplifier, not a standalone directional tool. It tells you dominance, not destiny. Next, let's move to the Fear and Greed Index, but not the retail version you see online. Sigma Quant's Fear and Greed Index is built entirely from price behavior, true range absorption, directional expansion, and volatility normalized movement. It's a regulated oscillator between 0 and 100. It doesn't track emotion. It tracks how price reacts to stress. Think of it like this. Price itself has a mood, and that mood is visible in the way it expands during pressure. When the index flips, meaning it crosses a structural threshold, it marks a sentiment regime shift. These flips are rare on the weekly time frame and usually occur at pivots, but pivots can be both tops and bottoms. In strong uptrends, an FGI flip from fear back into neutral often marks the beginning of a new leg higher. In weakening structures, that same flip often precedes deeper drawdowns because it reflects temporary relief, not actual demand. This week, FGI flipped, and we treat this signal as a hint for a temporary reversal. Now let's talk about all-time high drawdown. Bitcoin is currently down approximately 26% from its highs. This number is more important than it looks. Throughout Bitcoin's history, the 25 to 30% drawdown window has been the typical depth of mid-cycle corrections in ongoing bull markets. This band represents the point where leverage clears out, weak hands capitulate, and strong hands reload. But it can also mark the pre-breakdown zone during macro distribution phases. That's why ATH Drawdown is not a directional tool, it's a location tool. It tells you where you are in the cycle, not where you're going next. Now the Z-score price probability model. A Z-score tells you how far price is from its moving mean in units of standard deviation. If price is at 0 sigma, it's at fair value. At -1 sigma, it is mildly oversold. At -2 sigma, it is deeply oversold. These models work well in mean reverting environments and poorly in strong trends. This week, Bitcoin touched the -1 sigma band on the weekly model. Historically, this supports a local bounce, but the -2 sigma zone, which sits around $68,000, remains open. Until that region is tested or rejected, downside continuation remains on the table. Now let's expand on MVRV Momentum, one of the most important valuation tools in on-chain analysis. MVRV stands for market value to realized value. Market value is just price times supply. Realized value is something different. Realized value represents the aggregated cost basis of all coins in circulation, based on their last on-chain movement. This means MVRV compares today's price to the price at which each coin last moved, which is a proxy for the market's collective cost basis. When MVRV is high, the market is overvalued relative to its cost basis. When MVRV is low, it is undervalued. But the momentum of MVRV is even more powerful. MVRV Momentum measures how quickly valuation is shifting relative to realized price. When it flips negative near cycle highs, it often marks the beginning of structural downtrends, not because price is high, but because demand is slowing faster than supply distribution. This week, MVRV Momentum flipped negative. Historically, this is one of the earliest and most reliable signals of developing downtrend conditions. Next, we look at logarithmic regression bands. Bitcoin grows exponentially over long horizons, not linearly. Linear models break. Logarithmic models don't. These regression bands map Bitcoin's historical growth curve, creating long-term equilibrium channels that price tends to oscillate within. They reveal where Bitcoin usually finds bottoms, where it usually overheats, and where fair value tends to sit over multi-year periods. Recently, Bitcoin touched the pre-low regression band around $77,000 and bounced. Historically, this is a region where mid-cycle corrections find support. This is one of the few structurally bullish arguments this week. Finally, we come to the 30-day versus 365-day moving average structure, which is arguably the most important indicator in this entire script. The 30-day moving average represents short-term market reaction. The 365-day moving average represents long-term structural behavior. When the 30-day sits above the 365, short-term reactions reinforce the long-term trend. When the 30-day sits below the 365, short-term reactions conflict with long-term trend and rallies tend to fail. This indicator is brutally simple and brutally effective. It tells you whether the trend is structurally up or down. It tells you whether bounces are real or reactive. And it tells you whether the market is in a bull regime or a bear regime. Right now, the 30-day average remains below the 365-day average after flipping negative last week. As long as this condition persists, the market is in a structural downtrend. And in a structural downtrend, rallies are counter-trend until proven otherwise. So let's bring it all together. Our fear and greed index shows a sentiment regime flip, but in a weakening structure. Meaningful volume shows that sellers still dominate. The ATH Drawdown places Bitcoin in the historical reversal zone. The Z-score model shows oversold conditions, but deeper sweeps remain open. Logarithmic regression bands support a bounce from long-term equilibrium. MVRV Momentum has flipped negative, which is one of the strongest early downtrend signals. But the 30 versus 365 structure remains firmly bearish. This is classic conflict regime behavior, mixed signals, opposing forces, and elevated volatility. Historically, conflict regimes produce counter-trend bounces, followed by continuation in the direction of the structural trend. Right now, that structural trend is down until proven otherwise. If you want deeper, more systematic analysis like this, full indicator breakdowns, cycle modeling, regime detection frameworks, and quantified probability maps, we regularly publish our 100% free of charge Sigma Quant newsletter on Substack. It's built for investors and traders who want clarity instead of noise, and who want to understand how the market actually works beneath the surface. If you're not subscribed yet, now is the best time. Please also leave a like and subscribe to our channel for more data-driven analysis. Thanks for listening.